Let me tell you what happened to two people last Tuesday morning. Person A woke up at 6:47 a.m. Alarm, hit snooze twice, dragged themselves into the shower, drove 40 minutes in traffic, sat through 3 meetings that could have been emails, ate lunch at their desk, drove 40 minutes back, made dinner, watched an hour of something they won't remember, went to sleep. Net result, roughly $230 in earned wages for the day. Every dollar of it required every hour of it. Person B woke up at whatever time they wanted, checked their phone, there was a notification. $1,000 had just landed in their account. They hadn't done anything to earn it that day, or the day before, or the week before. It appeared because they own shares in companies that decided to share their profits. Then Person B made coffee and decided how to spend their Tuesday. Now here's the part that should bother you. Person B didn't start out different from Person A. They didn't inherit money. They didn't win anything. They didn't find a side hustle that went viral. They made a specific series of financial decisions over a specific number of years that eventually produced a machine that runs whether they're awake or asleep, whether they're working or not, whether the economy is good or whether it's making everyone nervous. That machine is called a dividend portfolio. And the reason most people don't build one isn't that the math is complicated. The math is completely transparent. I'm going to show you every number today. The reason most people don't build one is that nobody ever showed them the honest version of what it takes. The real capital required, the real timeline, the real traps, the real behavior that separates the people who get there from the people who talk about getting there for 20 years and never do. That's what today is. No yacht, no lifestyle content, no $100 a day passive income thumbnail energy, just the actual map. My name is Marcus, and I spend a lot of time breaking down the distance between how financial concepts get sold and how they actually work. Before we go any further, nothing in this video is financial advice. This is educational content. I'm here to show you the math and the mechanics so you can make your own informed decisions. Before we talk about generating $1,000 per month in passive income, I need to put the American financial landscape on the table because the gap between where most people are and where this conversation starts is real. And I'm not going to pretend it isn't. The median American household income is about $74,000 per year. The median American household has roughly $8,000 in savings, not $8,000 in investments. $8,000 total liquid savings. Meanwhile, total U.S. household debt sits at $17.5 trillion. The average American carries $6,501 in credit card debt at an average APR of 21.59%. Here's why that matters specifically for this conversation. If you have $6,500 in credit card debt at 21.59% interest, you are paying approximately $1,400 per year in interest charges. That's $117 per month. Going out, not coming in. The dividend portfolio we're going to build today eventually produces $1,000 per month coming in. But you cannot build it efficiently while paying 21% on credit card debt simultaneously. The first act of dividend investing for most people isn't opening a brokerage account. It's eliminating the debt that is currently charging more than any reasonable investment returns. That's the real starting line for most people, not a philosophy, a math problem with a correct order of operations. Now, with that established, let's talk about the machine. The entire math of dividend income comes down to one variable, dividend yield. Dividend yield is simple. It's the annual dividend payment a company or fund pays you, expressed as a percentage of the current price. If a stock trades at $100 and pays you $4 per year, the yield is 4%. The formula for $1,000 per month works backward from there. $1,000 per month is $12,000 per year. To find how much you need to invest, you divide $12,000 by the yield you're targeting. At 3% yield, $400,000. At 4%, $300,000. At 5%, $240,000. At 6%, $200,000. At 12%, $100,000. Write those numbers down, because the rest of this video is about understanding which of those numbers is real, which is a trap, and exactly how long it takes to get there depending on what you can contribute every month. Look at that 12% number again, $100,000. That's a car. That's a down payment on a house. That's a number that feels reachable in a way that $400,000 does not. And that's exactly why this is the most dangerous number in dividend investing. Yield is calculated by dividing the annual dividend by the current stock price. That means yield goes up for two completely different reasons. Reason one, the company increases its dividend payment, more money to shareholders. This is good. This is what you want. Reason 2. The stock price falls. The company isn't paying more. The price dropped. The same payment divided by a smaller price looks like a bigger percentage. Let me make that concrete. A company trading at $100 pays $4 per year, a 4% yield. Now imagine that company runs into serious problems. The stock falls from $100 to $33. That same $4 annual payment is now an 11.8% yield, nearly 12%. To someone scanning for high yields, that number looks like an opportunity. What it actually is, a company in distress, likely to cut or eliminate its dividend entirely, and a stock that has already lost 2/3 of its value. You buy in at the 12% yield, the dividend gets cut 6 months later, the stock drops another 20%, and you have lost real money chasing a number. This is what investing professionals call a yield trap. A sky-high yield is often not a signal of generosity. It is a clearance sale. Everything is marked down because something is wrong with the merchandise. This is why serious dividend investors look for yields between 0.5% and 5%. Not because higher yields don't exist, because a yield outside that range requires an explanation. And most of the time, the explanation is not one you want. Path 1. The Broad Dividend Fund. This is the foundation, the highest capital requirement and the lowest probability of something going wrong. A broad dividend fund holds hundreds of established companies across multiple sectors. Not the stocks making headlines, the ones writing checks to shareholders through every recession, every market crash, every period of economic turbulence for decades. Utilities, consumer staples, healthcare, companies selling things people buy regardless of what the economy is doing. Electricity, food, medicine, household products. The investing world has a name for the elite of this category. Dividend aristocrats. Companies that have increased their dividend payment. Not maintained it, increased it for at least 25 consecutive years. Coca-Cola, Procter & Gamble, Johnson & Johnson. These companies raised their dividends through 2008, through COVID, through every downturn since before most people watching this video were born. Think about what that actually means. Bigger checks to shareholders every single year. No matter what, that is not luck. That is that a business model built on products with durable, inelastic demand and management with the financial discipline to protect the dividend regardless of conditions. The yield, 2.5% to 3%. Not exciting, but it grows every year as the company increases its payment. And the principal is protected because these are real businesses with real earnings that have survived everything the last 25 years threw at them. Path 2, REITs 4 to 6% yield. REITs, real estate investment trusts, own income-producing real estate, office buildings, apartment complexes, warehouses, data centers, medical facilities. They are legally required by the IRS to distribute at least 90% of their taxable income to shareholders. That legal requirement is why their yields are structurally higher than typical dividend stocks. Many REITs yield 4% to 6%. At that range, you reach $1,000 per month with $200,000 to $300,000 invested, meaningfully less than the broad fund approach. The trade-off is sensitivity. REITs move with interest rates. When rates rise, REIT prices often fall. Office REITs took a significant hit as remote work changed occupancy patterns post-COVID. The income can be reliable, but the portfolio value swings more. For an investor with a long enough time horizon not to panic during price drops, REITs are a legitimate path to the target with less starting capital. Path 3, sector-specific investing. Energy companies, infrastructure, pipelines, telecommunications. These sectors frequently yield 4% to 5%, sometimes higher. The math gets you to $1,000 per month with around $240,000 to $300,000 invested. The risk is concentration. You are betting on one. Industry's continued health. Energy companies pay exceptional dividends when oil prices are strong. When commodity prices fall or regulatory environments shift, those dividends can be cut dramatically and the stock price typically falls at the same time, compounding the damage. Sector investing works as a component of a diversified portfolio. As a primary strategy, it carries more volatility than most income builders want to live with. Path 4, individual high-yield stocks. Individual dividend-paying stocks at the higher end of the yield spectrum. At 7%, you're at $1,000 per month with about $171,000 invested. The lowest capital requirement of any realistic strategy. Also, the highest individual company risk. When you own a broad fund and one company cuts its dividend, you barely notice. When you own 6 individual stocks and one cuts its dividend, you just lost 17% of your income stream, while likely also watching that stock's price fall because dividend cuts and price. Drops tend to happen together. This requires monitoring payout ratios. What percentage of earnings are paid as dividends? A company paying out 90% of earnings has almost no margin if earnings dip. Individual dividend investing can work. It requires more discipline than a fund approach, and the consequences of getting it wrong are more concentrated. Path 5. The Growth Hybrid. A broad market index tracking the S&P 500 yields roughly 1.5% in dividends. To generate $1,000 per month from dividends alone, you'd need $800,000, the highest capital requirement of any approach. So why is this on the list? Because this approach delivers approximately 10% annual total return, dividends plus price appreciation combined. At 10% total return on $200,000, you could generate the same $12,000 per year by selling roughly 6% of the portfolio annually, harvesting total returns, not waiting for dividends alone. The risk is sequence of returns. If the market drops 40% early when you've started, drawing down, selling at depressed prices locks in losses in a way dividend income doesn't. For investors with 20 plus years before needing income, total return often wins mathematically. For investors who want the clarity of deposits, arriving without sell decisions, dividend strategies win psychologically. Both of those things are real. The range is real, $150,000 to $400,000 for dividend-focused strategies, depending on risk tolerance and ongoing attention. The question now is, how you actually build those numbers, and how long it honestly takes. Here is the single behavior that separates people who reach $1,000 per month from people who are still describing their plan to reach it 15 years from now. Reinvesting dividends. Every time a dividend payment hits your account, you have a choice. Spend it, or use it to buy more shares. Which pay more dividends? Which buy more shares? Which pay more dividends? Compounding the position without you doing anything. Let me give you the specific numbers. Start with $50,000 in a 3% dividend fund. Never add another single dollar. Year 10. Reinvested portfolio. Approximately $67,000 to $70,000. Generating over $2,000 annually. Spent, still $50,000, still generating $1,500. Year 20. Reinvested, roughly $90,000, generating approximately $2,700 per year. Spent, $50,000. $1,500. Year 30. Reinvested. Approximately $121,000. More than double the original investment, generating around $3,600 per year. Spent $50,000. $1,500. Same starting capital, same yield, one behavior. Completely different outcome. This is what the fruit tree analogy actually means in math. Eat the fruit, you get fed today. Replant the seeds, eventually you have an orchard. Most people treat dividend reinvestment as optional. It is not optional if you're building toward $1,000 per month. It is the engine. Every brokerage platform has a DRIP option. Dividend reinvestment program. Turn it on. Leave it on. Do not touch it until you actually need the income. The honest timeline. How long does this actually take? This is the question the inspirational content never answers directly. Here it is, with actual numbers. Scenario. 0 invested, contributing monthly. Targeting a 3% dividend yield. Reinvesting all dividends. Conservative 4% annual price appreciation. Roughly 7% total annual return. The range, 11 to 25 years, is the real answer depending on your monthly contribution. The person who reached $1,000 per month in 3 years either started with substantial capital, took on substantial risk, got exceptionally lucky with timing, or is showing you something that is not what it appears to be. All 4 are common. When the $1,000 notification appears on person B's phone, the government notices. Dividends held in a standard taxable brokerage account are taxable income in the year you receive them. Qualified dividends, which most U.S. company dividends qualify as, are taxed at preferential capital gains rates. For most people, 15%. Higher earners, 20%. Lower earners, potentially 0%. At 15%, $1,000 gross dividends leaves you with $850 after federal taxes. To net $1,000 per month, you need to generate approximately $1,176 gross, meaning the capital requirements in every scenario above increase by roughly 18%. The $400,000 at 3% yield becomes closer to $472,000. to net the same $1,000 after taxes. The most tax-efficient solution: prioritize tax-advantaged accounts. In a Roth IRA, dividends compound tax-free and qualified withdrawals in retirement are completely tax-free. The 2024 contribution limit is $7,000 per year, $583 per month. Inside a Roth, that $400,000 portfolio generates $1,000 per month, and you keep all of it. The trade-off: you generally cannot access the money without penalties before age 59 and a half. If your target is dividend income before retirement age, you'll need to build some of this in a taxable account and factor in the tax drag accordingly. Strategy most investors use: max the Roth IRA first, then contribute to taxable accounts. The compounding difference over 20 years is not marginal. It is substantial. I'm going to say something that the dividend investing community does not love to hear. If you are in your 20s or early 30s with a long time horizon, focusing primarily on dividend, income may not be the fastest path to financial independence. Companies that pay large dividends are distributing profits to shareholders instead of reinvesting them in the business. For mature companies with limited growth opportunities, utilities, consumer staples, this is appropriate. They don't have better uses for the money. They write you a check. For younger, faster-growing companies, those same retained earnings, if reinvested into the business, can generate dramatically higher returns. The S&P 500 has returned approximately 10% annually over long periods. Total return combining dividends and price appreciation. A dividend-focused portfolio typically returns 7% to 8% lower because the companies are selected for yield rather than growth. The difference between 7% and 10% compounded over 30 years at $500 per month. At 7%, approximately $567,000. At 10%, approximately $1.13 million. Same contributions, same time. One number is double the other. So, why are we talking about dividend investing at all? Because the psychological component is real. There is something qualitatively different about receiving a deposit you didn't work for. It doesn't feel like paper gains that can evaporate. It feels like income. It makes the wealth feel tangible in a way that a rising account balance doesn't always. And behavioral finance research is clear. The investor who stays invested at 7% for 30 years significantly outperforms the investor who earns 10% but sells during corrections. The strategy you can actually follow consistently beats the theoretically optimal strategy you abandon when it gets uncomfortable. The 5 steps: what to do this week. Not someday, this week. Step 1. Calculate your real net worth. Assets minus liabilities. If you have significant high-interest debt, credit cards at 21%, personal loans at 15%, pay those off before building a dividend portfolio. Guaranteed 21% return by eliminating debt versus uncertain 7% to 10% from investing. The math has a correct answer. Step 2. Open a Roth IRA if you don't have one. Contribution limit, $7,000 per year in 2024. Inside this account, every dividend compounds tax-free. This is the most efficient container for dividend investing available to most Americans. Step 3. Choose your starting investment. For new investors who want simplicity, broad dividend ETFs, VYM, Vanguard High Dividend Yield ETF currently yields approximately 3%. SCHD Schwab US Dividend Equity ETF approximately 3.4%. Both available at any major brokerage with zero trading commissions. Both give you instant diversification across hundreds of dividend-paying companies. Step 4. Turn on DRIP. Automatic dividend reinvestment. Every platform offers this. It takes 30 seconds to enable. Once enabled, every dividend payment automatically buys more shares. Do not turn this off until you actually need the income. Step 5. Set up automatic monthly contributions. Decide what you can actually invest monthly, not the aspirational number, the real number. Automate it to transfer on payday before you see the balance. The investors who reach $1,000 per month are almost universally not the ones with the best stock picks. They are the ones who made contributing automatic and left it alone. Person A and Person B both exist. Neither of them was born different from the other. Person B just understood at some point that money can work the same hours you do. That capital, once deployed correctly, doesn't require you to trade your Tuesday for it. That there is a machine available to anyone willing to build it. Slowly, consistently, without chasing the shiny number that turns out to be a trap. The machine requires $150,000 to $400,000 depending on which path you take. It takes 11 to 25 years to build depending on how much you can contribute each month. It requires reinvesting the dividends instead of spending them, especially early on. It requires choosing stability over the seductive math of the high-yield trap. It requires keeping tax efficiency in mind, and it requires the patience to understand that the slow, boring, transparent math is the real version, and the yacht photo is the filtered version. The gap between wanting that $1,000 notification and actually receiving it is not talent. It's not income level exclusively. It's not luck. It's time, consistency, and starting today instead of when the conditions feel right, which they never will. If this video gave you the honest map instead of the highlight reel, hit that like button and subscribe because this is exactly what I do every week. Drop a comment and tell me, which path are you on? And what's your current monthly contribution number? I want to know where you're starting. See you in the next one.